Hey, this is Mayor Valensky with Driving Markets. Let's look ahead at 2023 and let's just see what is going to happen, okay? Let's just rearrange the camera. All right, so before we do that, let's look at 2022. So inflation raised its ugly head back in January, February, before the war in Russia, okay? Before the war in Ukraine, between Russia and Ukraine. Inflation was already there. Inflation came about as a result of the excessive stimulus packages by the US and Europe and the UK and Canada, etc. But these stimulus packages started back in 2008 with the major financial crisis and obviously with the overselling of the mortgage book in the US on really dodgy and ugly mortgages, okay? Now that stimulus package has eventually, which is a money supply issue, that is printing money, that was the foundation, that was the bedrock of inflation that was likely to happen at some stage. What was surprising, and that didn't really happen for quite a long time. It's incredible that inflation stayed so low with all of these billions and trillions being poured into the economies. Inflation didn't really show itself. What actually happened was in the pandemic and the corona, you had two factors came in to impact markets. There was the money supply, and there was also the problems with the supply of goods, mainly from China around the world. Because once the pandemic hit, the corona pandemic hit, then there was a lockdown globally amongst all the factories, the manufacturing, the wholesalers, deliveries, ships, planes, postal service, any type of delivery that was frustrated and stopped. And that caused really a supply-driven inflation, okay? So we could say that the core starting point of inflation was a supply-driven inflation, and then adding to that the freedom of money with low interest rates, that was like oil to the fire. Looking at those stimulus packages, let's just go over and remind the viewers, remind you where we're at, what was happening during the pandemic. Well, during the pandemic, the governments were so frightened that there could be a major global economic crisis. They pumped money into the economy by way of a personal check landing at your door, by way of a furlough scheme in the UK where you were paid up to £2,500 a month per person by the UK government. They were giving government loans, bounce back loans, finance loans, easy payback, grants. Everything was just flow of money into businesses in order to allow them to function. Also they were given loans or they're given money to retain employees rather than lay them off and increase the unemployment during the corona period or post-corona period. And what happened there in the post-corona period, if you recall, a lot of people unfortunately just didn't go back to work, were too ill. Even worse, there were millions of deaths, and that caused a big hole in the labour market globally. And because a lot of people did not return to their jobs, and because a lot of people unfortunately died as a result of COVID-19, or the Chinese flu, if it's called, that created a vacuum. It created a space within the labour market, and therefore the cost of labour shot up. So you have unemployment was high initially during the COVID. Once COVID finished, then what happened was there was a massive demand on labour and a movement of labour. And also a lot of people were working from home, cutting back on the travel and cutting back on the expenses of having to get into work. And that added more money or more spendable income into the pocket of the worker or the labourer. As a result of that, they felt rich and they went out and bought luxury goods or cars or any computers or any types of goods where they get their hands on, and that caused a massive upsurge in consumer spending. But remember that the supply line was still frustrated. So not only have you got an undercurrent of consumer demand, which is pushing up prices, you've also got a supply limitation. The goods just can't get to the shelf, they can't get to the store, they can't get out to you, and therefore as consumer demand rises and causes an incongruous or causes an imbalance with the supply, therefore higher demand than supply brings about rising in prices, rises in prices, price increases, and which is effectively inflation. So go over those three factors again. It started off with a supply-driven issue. Then on top of that, you've got consumer demand with the opening up of all the economies. The consumer was locked down, locked in, and the human being naturally wanted to get out and spend. So all the money that they had from the stimulus package, which was the money supply, gave them the fuel for the fire, and they went out and bought the goods. But again, because there was no supply, prices went up, inflation rose. Now, adding to that, the war in Ukraine. Obviously, that frustrated even further inflation, but Putin was not the cause, which is contrary to what Biden and the US government in the West is trying to portray, that Putin is the cause. He's not the cause. He added to the misery of inflation, but he's not the cause of inflation. So we have to be very clear that as much as we don't agree and oppose what he does and what he's doing in Ukraine, we don't want to point the inflation blame onto Putin. The inflation blame started already back in 2008 under the Bush administration, continued with the Obama administration, and was exacerbated by then with Trump and with Biden giving another 1.9 trillion about a year ago to the US economy. So everyone takes a portion of the blame if you're looking for the blame game, but it's definitely not Putin. Putin is only part of the crisis, is not the crisis. So even if Putin was to withdraw from Ukraine, you'd still have the undercurrent of inflation still there because there's a global supply issue. With Putin invading Ukraine, obviously that aggravated oil prices and also soft grain prices, the wheat, the barleys, the soyas, etc., that aggravated, but they've actually come down significantly to below where they were at the beginning of the war. With all of those factors, that pushed equity markets into very volatile territory and made them go south. The biggest victims of the equity markets, or the drop in the equity markets in 2022, was the high-tech sector. So in driving markets, we stated over and over again, sell the high-tech sector, sell it, keep on selling the high-tech sector. Why? Because that is totally dependent on stimulus, it's totally dependent on money, it's totally dependent on cheap money. And as you saw bond prices rising and the cost of borrowing rising, then you saw those high-tech shares absolutely dumped or trashed. Okay, and we're talking about the Apples, the Googles, the Netflix, the Metas, the Amazons, the Teslas. All of them are significantly down. Those are the big heavy hitters. Okay, now moving on to 2020, that's the background, and that led all the way through to the end of 2022. Looking into 2023, you're going to have more or less a continuation of those issues. You've still got supply issues. You've still got the war going on in Ukraine, and you've still got, to a degree, less liquidity than there was because interest rates has taken away, rising interest rates taken away the ability of the consumer to spend what they want because the cost of housing has gone up. And as the cost of housing has gone up, also the cost of borrowing has gone up, cost of cars, etc., etc. So you'll see an impact over 2023 where the consumer is getting less and less money to spend. Now, that less and less money to spend will have obviously an impact on corporate earnings. So corporate earnings will fall as a result of them selling less goods. So you're going to see that expressed and portrayed and projected in sales of Apple iPhones or Samsungs or cars or luxury goods. You'll see that demand ebb away, fall away, as less and less money is available to the consumer, as more money goes on accommodation, housing, interest rates, business loans, overdrafts, etc., etc. So that's what's likely to happen in 2023, and that will lead into a recession. Now, the recession, in my opinion, is going to be pretty deep, probably worse than 2008. So I'm putting my neck on the line here, and I'm saying that the recession in 2023 is going to be worse than the one in 2008. Okay, you're going to have increasing unemployment, increasing interest rates, increasing cost of borrowing, and as a result of that, you could have foreclosures in the property market. The property market, as I see it, will fall around about 20 to 25% at least in 2023. So it's going to be a pretty serious recession. And when they say cash is king, it means that money in the banks. You should really put some money aside or have your rainy day money there ready, because you're going to end up using it in 2023. I'm not looking to be miserable and dim and gloom and all. I'm just talking about reality, what's likely to happen. There'll be more and more employers, more and more big companies going bust as their cash flow contracts, and they end up with less money available in order to fund their businesses. For example, take one of bed, bathrooms and beyond, the BBBY. The reason why I talk about that, because that is a major consumer product: bathrooms, sinks, all types of beds, linen, mattresses, etc. And they've taken a dive in the US, and they're likely to call in for bankruptcy, or they're likely to announce Chapter 11. They've only got $200 million left of available money. And the CEO there and the CFO, who unfortunately committed suicide a few weeks ago, but the new CFO, have stated clearly they simply don't have enough money to run. Now, the reason why I'm saying that is it's an example of where we're at in regarding companies and what crises they're going to be facing in 2023. Other companies to look at that are going to be in crisis is Meta, and I've said all through 2022, Meta or Facebook is in big problems. They're wasting too much money on this virtual metaverse, okay? The virtual metaverse is not the right environment when money is tight, okay? So the metaverse is not going to take off. It's not real, it's not tangible goods. And I think Mark Zuckerberg and the Facebook management, the Facebook media, the Facebook marketing, all of the Facebook board have made a big mistake, where even the hedge funds or the investment funds that invested in Facebook are now calling them to say, cut it, let's forget this trash and let's focus on the real business, because Facebook's model is advertising revenue. Now, if we're talking about advertising revenue, there's been a contraction within the sector of advertising revenue. Why is that? There's a lot of players that are looking for the same small market business. And not only that, those people that are looking to market advertise are now negotiating the fees much more aggressively, and therefore cutting back on what they're willing to spend on marketing and advertising. That's going to impact numbers like on Facebook or Google or any company that requires media for them to produce revenue. Okay, that's going to have a big impact. The other one to look at is Amazon. As I said last week, Jeff Bezos looks like he's going to go back to Amazon. He's not the cause that Amazon, by him leaving, that's not the cause that Amazon fell. What happened was that Amazon has had supply issues, delivery issues, a little bit of loss in management there. Not sure what they're doing. They're going to be laying off some staff. The shares completely have tanked from 180 down to about $84 a share, and likely to go lower in the near term. That's another example of where the contraction is within the global economies. The other one to look at, which is a shocker, I know, but I did say this one, was Tesla. Tesla's been riding high the whole year, and come around about November, we did say on driving markets that, you know what, it's time to probably get rid of it at $230 a share. It's dropped all the way down to $105 a share. The shares are just dropping because they've got supply issues and pricing issues in China that's not selling the same level of cars that they were in 2021. So 2022 has seen a downtrend in overall Tesla sales, and as a result of that, the shares are on a downtrend when it comes to their sales. So Tesla looks like it's going to go to around about the $70, $75 a share. I know it's a shocker because there's big Tesla fans out there who just don't want to hear anything negative about Tesla. I'm a big Elon Musk fan, but really Tesla is probably a sell at these levels, and you probably see it go down even further over the next month or two. You can't, the other one I want to mention actually is Apple. So Apple, as I said, over the year is not innovative. It's produced nothing for the last 10 years. It's redesigned the iPhone, it's brought out these AirPods, a little bit of redesigning, a little bit of maybe innovation. It's a cash cow business, so it's looking to get as much money from its existing customer base as possible. But the iPhone 14 sales, the i14, and its overall production is not particularly good, and those sales have fallen off, and therefore Apple has dropped down about 126, 128, likely to fall below $100 a share in the near future. Apple needs to revamp itself and start thinking, what are we going to do? What are we going to do? Are we going to produce something innovative, or is it just going to be the same iPhone redesigned over and over again? And you've got all the iPhone cronies and the iPhone, you know, the big hip bands, everyone's following them around, that they're going to keep on buying the iPhone. But that marketplace is contracting, and there's more and more people now are delaying buying the iPhone or the new iPhones because the existing iPhone more or less is the same as the new iPhones. Until Apple comes out with something innovative, then it's likely to fall even further. Can't go through a session without discussing cryptocurrency. That was the big in thing back in 2022, the beginning of 2022. You remember at the end of 2021, beginning of 2022, you had Bitcoin around about $68,000 a coin, and everyone's talking about it going to 100,000, then to 200,000. There was a whole euphoria in the crypto sector. It was just going up and up and up and up and up, and it's just come crashing down. There's been a lot of crisis within the crypto sector. You've got a lot of companies have gone bust. You had the biggest one was FTX, Sam Bankman-Fried. I mean, that is just crazy story. They had a $3.2 billion fund, or dollar exchange, just went belly up, and now he's standing arraigned for fraud, money laundering, etc., etc. Also, Genesis is filed for bankruptcy. They've got major problems. Their bank is also under pressure, SI, because they're the ones that housed all the money, etc., etc. So you had a lot of crises in the crypto sector, a lot of exchanges under pressure. Binance tried to come out with a recovery fund to add confidence to the consumer that the money is safe, but really this huge impact of exchanges going bust or not paying out has impacted to such a degree where the consumer has lost confidence in the crypto sector, and Bitcoin has lost volatility. It hardly moves 2 or 3% a day. At one stage it was running 6-7% a day, hardly moves. It's hanging around the 16,500 level, likely to go all the way down to below 10,000, especially if there is a recession. Then that recession, if it's deep, is going to send all of the high-risk assets south. So that's the high-tech sector and the startups and the SPACs even more, and obviously the crypto sector. Talking about SPACs, I don't know if you ever invested in them, but they are special purpose acquisition companies, and those businesses have just tanked between 95 and 98% loss of their value because they were well overvalued, or too overvalued at the beginning at 20 billion, when they've not produced any profits whatsoever, not 1 cent of income, and yet they're valued at 20 billion or 30 billion or 40 billion. Complete waste of time. They've come down by 98%, and even that puts the valuation at 50 million or 100 million. It's far too high. These SPACs should be valued at around about 0.01% of their original valuation. Those of you who are foreign exchange traders probably expect, again, a dollar strength overall throughout the year. You're going to have some periods where there's going to be a bit of dollar weakness, which is obvious in all foreign exchange trading. But overall, you're going to have probably dollar strength. I expect inflation to keep on rising and interest rates to keep on rising globally, especially in the US and Europe. In the UK, you'll see interest rates rising there. I expect interest rates to be in the US by July about 7%, something like that, and inflation will be running at about 11%. I don't think they've got inflation under control. Again, I'm being contrary. Everyone is of the view that inflation is under control, everything's okay, everything's rosy, and we're going to finish 2023 on a high. I don't think that's going to be the case. That's my opinion, entitled to it, and again, it is only an opinion, okay? Expect bond yields to rise. So at the moment, the 10-year Treasury is running at 3.57%. I expect it by July to be around about the 4.5 to 4.8% on the US 10-year Treasury. Also, European bonds and UK bonds, expect the yields on those to rise further as the crisis sets in even more in Europe and the UK, and the economies begin to go south. There'll be more looking for those bonds and a secure yield. And that's more or less it. That's my sort of future year ahead with 2023 on driving markets. Well, I'd like you to subscribe. I need to get more viewing hours so you can share it with your friends, and you can also comment. Maybe we'll do some lives on YouTube. You can pass comments on that. Also, I've had some specific viewers that have asked for specific asset classes or specific impact, what happens if this goes up or that goes down. If you can just comment again, and what I'm going to do is I'm going to make a list of those people of what you're looking for, and then I will look to address each of those asset classes and give you the information that is needed. Okay, this is Mayor Valensky with the Driving Markets channel in my studio. Let's have a good year. Let's catch up. Speak to you soon.